Good morning, everybody, and what a fine morning to be talking about how to own property and when to incorporate. So today we've got myself, Paul Davison, and my colleague, one of our senior tax consultants, Ryan Snape, who will be talking to you about this subject. A bit about PD Tax, our vision. We enrich lives by making tax simple. And there's our mission there. What we do, well, what do we do? Well, we provide tax advice. It does what it says on the tin to business owners, individuals, high net worth people, overseas people coming to the UK, etc., etc. We provide a tax director partner service for accountancy firms. We do tax returns. We do share valuations. Some people don't know that, but we do share valuations of private limited companies. And we do deal with tax investigations and voluntary disclosures. So a little bit about today's session. We're going to finish at 10 a.m. on the dot. As ever, your mics will be disabled throughout the webinar, so you won't be able to talk to anybody. But obviously you can submit your questions via the Q&A box, and Laura will kindly ask myself and Ryan those questions at the end. If your question's not answered, we will get back to you, but today we do have a breakout session at the end whereby if you stay on the line, you can have a chat for 10 minutes with myself and Ryan about any topics you want to discuss. And then there's a general disclaimer that this presentation is for general information only and not advice. It's recommended that you seek competent professional advice before taking any action for you or your clients. Okay, so we'll pass on to Ryan, who's going to do the first part of the webinar. Ryan.
Thanks, Paul. Yeah, I'm going to just take you through the taxation of property rental businesses owned personally and company-owned property rental businesses, to hopefully give you an understanding of when we might want to incorporate a property business. So starting with personally owned property, the rental profits of a personally owned property portfolio will be taxable at the rates detailed on the slide there, which is 20% at the basic rate, 40% at the high rate, and 45% at the additional rate. And then there's not any national insurance on that income, so that's the extent of the income tax that will be applied. Now, one of the main disadvantages, which you may be aware of, is that mortgage interest is no longer deductible against, is no longer a deductible cost against rental profits. Instead, there is the basic rate tax credit system, which means that your mortgage at 20% of your mortgage interest costs are deductible as a tax credit against your personal tax. What that means in a nutshell is that basic rate tax payers are no better or worse off as a result of this system, but higher and additional rate taxpayers are going to lose out on 20 to 25% of tax relief on their mortgage interest costs. And then the final point, just to note down on the slide, is that when you have a personally owned property business, all of the property income in that rental business is going to be taxable in the year it's received, in effect, meaning that if you don't need all the income in the year, well, tough, you're going to be subject to tax on it. So we'll move on to the next slide. So how does it differ for a company? Well, there's going to be two occasions to tax when you operate a rental business in a company. First occasion is going to be within the company itself, where you'll be subject to corporation tax at 19% on any rental profits. I have noted on the slide there that that rate is set to increase to 25% from April 2023, the government has announced. Although, as I understand it, there's for profits up to £50,000, I believe the 19% should still be in force. But the main advantage of a property rental business being operated through a company is that mortgage interest is fully deductible in the calculation of the taxable profits. And from there, there's no further tax to pay until you actually withdraw those profits from the company. And there are various ways to do that. I've noted on the slides there that we can look at salary and dividends. We might also look at pension contributions or interest if there's a loan to the company. But probably the main way that people would withdraw those profits from the company are via dividends. And the rates are on the slide there. The first £2,000 of dividends you receive in the year will be taxed at 0%. And thereafter, those that fall into the basic rate will be 7.5%, 32.5% at the high rate, and 38.1% at the additional rate. So why own property personally? Well, if those rental profits are going to fall into the basic rate band, or otherwise are going to be within the personal allowance, then there probably isn't going to be too much advantage for you operating your property businesses by a company because of those two tax charges, corporation tax and when you withdraw the profits from the business. In addition, if your properties aren't mortgaged, then the ability to the basic rate tax credit and the restriction for personally owned property businesses isn't going to be an issue for you because you're not deducting those costs anyway. If you're going to sell the property in the future, then we're looking at capital gains tax if you own the property personally. So that's rates of 18% for basic rate and 28% for high rate for residential property. But of course, you get your £12,500 annual exempt amount. So, for example, if you're a married couple and you own the property jointly, you could conceivably exempt nearly £25,000 of the capital gains on the property. So if you're looking to sell in the foreseeable future, that's quite a valuable exemption for capital gains tax. And then, if you own relatively few rental properties, then those above points are probably going to be more likely to apply. Also, if you want to keep it simple, if you own property through a company, we'd have to file accounts at Companies House. We're going to have to submit a corporation tax return in addition to our personal tax obligations. And all the rental income, if all the rental income is required in the year of the receipt, for example, if you're going to exhaust the company of all of its profits each year and withdraw them all as dividends, well, then the ability to leave profits in the company isn't really going to be an advantage for you. Moving on to the next slide. A lot of these points are going to be the opposite of what we've just discussed in the previous one. If you're a higher additional rate taxpayer, we're paying tax at 45%. We might want to shelter some of those profits by using a company. If the properties themselves are highly geared, so there's a lot of mortgage interest costs, then the fact that we can deduct those against the profits, it's going to be a big advantage for us in the company. And if the properties are for long-term investment, obviously the point in the previous slide about having your annual exempt amount and being able to set that against your capital gains isn't really an issue if you're not planning on selling those properties. Generally, that'll be for larger property portfolios, so more rental income, more likely to be taxed at higher and additional rates, and more likely those properties are mortgaged. The ability to take income flexibly is an advantage of using a company. So you can, you don't necessarily need to take all those profits out of the company each tax year. You can leave some of them in. You might want to fully utilise more favourable tax bands and then leave the rest in to take a later date, managing your tax bill across tax years. And the final point on this slide is companies are generally going to be more flexible for inheritance tax planning because shares are more easily divisible than actual properties. If you wanted to divide your estate between certain beneficiaries, it's going to be easier to split up shares than it is to choose which properties are going to which individuals, keeping it fair. So I've got a small case study here just to demonstrate what we've discussed. Gareth is unmarried and receives just over £45,000 a year in salary. And he's also got 3 rental properties that he owns personally that generate £18,000 of rental profits. The properties are unmortgaged and he needs to take all the income each year to fund his lifestyle. So you'll see from those 2 calculations that Gareth's going to be marginally better off if he owns those properties personally from a tax point rather than using the company. However, some things to think about. What if those properties were mortgaged? Well, the ability to, Gareth is a high rate taxpayer, so that he's going to lose out on 20% of tax relief on those mortgage interest costs, whereas he won't lose that out on that in the company. So it might be better for him to operate via a company. What if he didn't need to take all the income each year? Well, if I just flip back a slide, if I can. No, I've gone the wrong way. Paul, sorry, Paul, would you be able to flip me back a couple of slides? I've gone ahead. One more, sorry. Thank you very much. Yeah, just taking a look at the right-hand side there. If Gareth didn't need to take all the income, I might advise Gareth to just take £5,000 of income from the property company. That way, he's fully utilising his dividend allowance and the remainder of his basic rate band, and he's just going to pay an additional £225 of income tax, bringing his total tax bill to less than £4,000 compared to £6,200 if he owned it personally. And then the final point: if he acquires more properties going forward, we're probably going to see the property company becoming a more attractive option because there might be mortgage interest costs, and he might want to start utilising that previous point and rolling the profits up. And the final point I want to make is with regards to planning around spouses and civil partners. Many of you might, in your tax planning, look to direct income where possible to the partner who pays tax at more favourable tax rates. You might have one spouse who's a basic rate taxpayer, one is a higher additional rate taxpayer. Well, where you've got property, personally owned property, the default position for jointly owned property is going to be 50-50, which might not give you the best tax result. There is planning we can do around that, and we can make an election for the property income not to follow 50-50, but to follow the underlying beneficial interests. But even then, the beneficial interest might not give us the best tax result, so we might have to do planning around changing that beneficial interest between the spouses. And this process is generally going to be quite arduous, and it's going to have to be done on a property by property basis. To undertake that same planning using a company, well, it's going to be a lot more straightforward because we can establish those shareholdings in such a way that the lower earner, the person with more favourable tax rates, may receive, say, the lion's share of the dividends from the property company. So we can set that up quite easily, and we can also change it quite easily, which is another advantage of the property company. But on balance, just before I move on, the property company most of the time is going to be the more favourable option because of that deductibility of mortgage interest, because of the flexibility around remuneration, not only across tax years, but also between, say, married couples, and because of the flexibility around inheritance tax planning. So I'm just going to move on now to a small poll that you can all get involved in. The question today: what are the main reasons that you think people would incorporate their property portfolio? The options on the screen are A, inheritance tax planning; B, paying corporate tax rather than income tax rates; C, to avoid the tax restrictions on interest payments by individuals; D, to share income better between spouses and civil partners; and E, to limit their personal liability. So fingers on buzzers. You can cast your votes now, and we'll reveal the results in about 30 seconds. Okay, I think that's nearly everybody. So we'll end the poll in there. And I'll share the results with you. So it looks like the standout result is that you will pay corporate rather than income tax rates, although avoiding the tax restriction on interest payments has come up not too far behind. Okay, so I'm going to pass you back to Paul now. He's going to take you through the incorporation process and how that can be done. Thank you very much.
Thank you very much, Ryan. So we've talked to the client, or we're a property owner, and we've decided to incorporate. We'd like to incorporate. We've done the numbers. We think it's the right thing to do. We want to incorporate. How do we do it? Well, I think it's an interesting topic, and one that's been debated by the tax profession over the last 5, 6, 7 years, really. I don't know, but I think now there's a clearer type of routes and clearer principles, guiding principles that allow you to make a decision. Sometimes the decision might be that it's too expensive to incorporate. Sometimes the decision might be, yeah, we can incorporate tax-free. Sometimes the decision might be, we've got to pay some tax on incorporation, but it's worth it because we think that we'll save that tax within 3 years, say you've been in the company. So yeah, I think it's been debated a lot, but so we're just going to tell you now what we think the options are in relation to incorporation. So there's two options really, quite simple. The first one is that properties can be transferred to the company in exchange for cash or a loan. So effectively just a sale. That's the first option. The second option is that the properties can be transferred to the company in exchange for shares. So that's the second option. That company, it could be a new company, or it could be an existing company that you've already got. If the properties have existing mortgages, then this is going to be an issue to think about quite early on in the process, because when we transfer those properties from personal ownership to a company, the lending is going to need to move as well, because the company is obviously a different borrower to the individual or individuals. And so that's one of the things we're going to need to do quite early on, is really to try to work out, speak to some banks, speak to some financing people as to how we're going to achieve that, and as to how it's possible. Wrong way. Okay, so the first option there was incorporate for a loan. So as I say, it's a literal sale of properties by the individuals to their company at market value. So in relation to that, we're going to have to pay SDLT, and we're going to have to pay CGT. So the SDLT is going to be on the whole property portfolio. There are some interesting reliefs we can look at to actually try and whittle that rate down. That's not a discussion for today, but it is worth thinking about if you do look at SDLT, it's not as straightforward as you might think. It actually tends to be a better result than you might think. CGT on all the inherent gains in the portfolio is going to be payable, less any annual exemptions. That's going to be at least a 28% cost probably on the inherent gains if it's a residential portfolio. But the benefit of incorporating for a loan is obviously we're getting the properties in there. We're starting to get the foundations built up. But one of the benefits that the incorporation for a loan has over the incorporation for shares is that this creates a loan from the company to the individuals, which can be drawn down over the years to come. Obviously, you've still got to pay the corporation tax on the rental profits, but any leftover cash can be drawn down as you see fit, and with no further tax payable, which can be a significant benefit. Or you can actually, what you could do is actually gift that loan to a successor, to a child, to somebody else, the family, as a means of mitigating that IHT in a tax-friendly way. The second way is to incorporate for shares. So it could be more than one person incorporating for shares. There could be more than one person with different shareholding in different properties. But what we do here is look at the total equity of the raw properties that are going to go into the company, and we issue the relevant number of shares, percentage number of shares, compared to the relevant equity that that individual has in the portfolio compared to the rest of the individuals. And the benefit of that is that the individuals should be able to avoid CGT and SDLT if the properties are owned in a partnership and the portfolio is run as a business. The downside is that there's no loan to draw down on in the future compared to the option one, where we could draw down that big loan for no further tax. Obviously, the key there is, do we have a partnership, and is the portfolio run as a business? So the two key tests we need to look at. I won't go into too much detail about those at the moment, but basically a partnership means something that's run with a view to profit between more than one person. and a business means that it's run with a view to make profit, as opposed to an investment, which is a business involves more activity, whereas an investment, on the other hand, is more of a you put your money in and you take the money out without doing too much work to get it. Okay, and the sundries to do with the incorporation are that we need to take care of the SDLT and CGT, and we've got to make sure we look at these things in each individual case, because they're not straightforward, and every case needs to be looked at separately. Use the right solicitors, because the solicitors that do this job need to have property ability, the ability to move the property. They also need to have the ability to deal with the corporate side of things, like the issue of shares in exchange for the properties, and get that right. So make sure we've got the right solicitors on the job, or it can make life difficult if not. And get your tax compliance right. Tax compliance tends to be around, obviously, the SDLT on transfer. If we think we're going to avoid SDLT via the, because we have a partnership, which is the reason why you would avoid SDLT. If we think we've got a partnership and we're avoiding SDLT, then what we do is we tend to write to HMRC post-transaction to tell them why we haven't submitted an SDLT form, because we're claiming that relief. That's the way we tend to do that. And obviously with the CGT, if you're claiming corporation relief, by definition, that is an automatic claim, but it would still be worth putting some white space information on the person's personal tax return form. If you're selling for a loan, obviously, you're going to have to file an SDLT form for the full amount of SDLT. And you're also going to have to put the incorporation of the properties onto your CGT pages to pay the relevant amount of CGT. Okay, so I think Ryan obviously summarised, had his summary earlier. My summary is very similar to his. If you want to hold property for the long term and pass it to the kids, etc., it should be in a company, especially if you want to build that portfolio and create some wealth in the portfolio. It should be in the company. And how you get it there, well, it depends on the size of the portfolio and whether there's any gains in it. Some people might decide they're actually going to park the amount of 2 or 3 properties already, and they think that moving them is going to give them the amount of problems with moving the mortgages, the amount of problems with paying CGT bill could be too high. So, they might just be an individual rather than the partnership. So what they could decide to do is retain those properties personally, and start buying future properties in a new company. But obviously, before you do the incorporation, you can what we tend to do is do the tax calcs before we do the incorporation to work out what the downside would be if we did have to pay the CGT and we did have to pay the SDLT in case HMRC start to find issue with what we've done. Okay, that's the end of the webinar today, technical side of things. Don't forget, if you've got an action to take away from this, every client's got different circumstances. One size does not fit all, and we talk to these people, we do this a lot. So call Ryan and I on that number to discuss any client situations that need attention, because, as I say, it's a case-by-case basis, and the outcomes, as far as I can see, are always different. It could be substantially different, it could be a little bit different, but every case needs to be looked at. We've now got a summer break, so enjoy that. And the next webinar is on the 10th of September 2021 this year, and it's VAT on property. Very interesting subject. Laura, do we have any questions from the attendees?
Yeah,
today?
we do. So the first question is, can the beneficial interest be changed if spouse's income change?
Yes. is the answer to that. But we probably would want to get a solicitor involved because it would warrant the transfer of interests between, say, the husband and wife. When you're looking at that, you need to consider things such as SDLT on the property because there is a change of interest, and oftentimes if there's debt attached to that interest, even though there's no actual consideration changing hands, the debt itself would be deemed as consideration. But generally we could look to change the beneficial interest. Although then you've got to get a solicitor involved, so there's going to be fees with that. And then we would look to make an election that the income would follow the beneficial interest, which I think, as I tried to point out when I was discussing it in the slides, is going to be an arduous process, and it's something you're going to have to do for each property. So that's one of the advantages of utilising a company.
Great, and got another question, which is what are the implications if you initially own personally and then want to move to owning under a company? If, say, you decide to start buying a number of properties.
I think when that question has come to us, I think as Paul's pointed out with regards to the reliefs that apply, in order for you to get incorporation relief, for example, you need to have a business that involves a material level of activity. So if you've just bought 1 or 2 properties and you're now thinking, well, let's put it into a company, it's perhaps going to be doubtful that you are undertaking a level of activity with regards to those 2 properties that would warrant it to be considered a business for the purposes of incorporation relief. So if you're in that scenario, we might be looking at the tax cost of putting those properties in, being capital gains tax and SDLT, versus the savings of those properties being in a company, or otherwise perhaps considering whether we just leave those properties in personal ownership and then set up a company going forward to acquire future properties.
Great. And when selling shares to access capital, how is the company valued for CGT reporting purposes?
Well, Paul, I'll let you have that one.
Are you sure? You're going to do them all. Thought I was having a morning off. Good question. How is it valued for CGT purposes? Well, I suppose it's a combination. The valuation, you need to do a valuation report, and the valuation report has 2 sort of aspects to it. It has obviously the property aspect. So we need a surveyor to value the properties in the business, and we also need to understand if there's any liabilities to knock off that, any sundry, maybe some cash in the business. We need to look at all that stuff, and then we need to look at so that forms the value of the actual assets of the company. Then we look at the company and we say, right, what shareholding is being sold, because we will be applying some sort of discount for a minority. Obviously, with a trading company, the minority can be for like a 5%. The 5% holding for a trading company the discount might be sort of 50%. Whereas with a property company, it's more likely to be sort of, because it's all asset wealth, the discount is not as high. So it might be worth the discount might be 10% or something like that. But it depends obviously what the valuation is for. The valuation could be for tax, it could be for selling. I think you mentioned selling. So it's, at the end of the day, it's, a buyer is what a willing buyer and seller will agree to pay. But if all the information is put together properly in the valuation report and confirmed by both parties, then that's obviously a good start to work out what the value is going to be.
Great.
One more question, I think, Lodge. One more, then it's going to be 10 o'clock.
Yeah. Practically speaking, what is the value of the properties required as a rough minimum to cover costs and make it on a cost base practical to consider? Don't want to waste clients' time going down this route to find out the fees outweigh the benefits.
Ooh, good question. Yeah, I think probably probably three would be about your minimum, probably. don't know, might be less. Depends on the size and what your other income is. Obviously, if your husband and wife partnership, and you've got you're all both earning, 100 grand or above the 50 grand mark. So any rental profits you make are going to be taxable at 40%, and that makes it obviously more advantageous to put, say, 2 properties into a limited company. So I don't think there's never any sort of real definitive mark, but maybe 2, 3. All about the future, asking the questions, do you want to build up a portfolio? If the answer is yes, they want to build up a portfolio, they don't want to spend the cash, they want to reinvest it back into properties, then, the first one might go into a limited company. Obviously, with the incorporation process, there are going to be fees. The fees might be somewhere between 10 and 20 grand in total, the tax fees and the corporate fees. So that's going to be a cost, which you need to look at in terms of the SDLT, whether it's SDLT cost, is a CGT cost, and just make a decision. Really, there's no hard and fast rule. Okay, thanks for that. Thanks for that, Laura. That's brilliant. So it's now 10 o'clock, so the webinar is now finished. So thanks very much for your time. Hope you enjoyed it, and hope you've learned at least one thing from today's session, and that'll be a success. In a minute, we're just going to, myself and Ryan are just going to stay on the line, and in 1 minute, we're going to enable your mics. And if you want to bombard us with questions, you can do. So stay on the line if you want to ask us a few questions.
This is where everybody leaves, Paul.
Still got a few people left on.
Yeah.
Right. Okay. Who we got left? All right. Okay, we've got a few people left on, so I'll allow these people to talk. Okay, everybody. Hello. Are you all right? Any questions to ask us? You can unmute your mic and you can talk.
Good morning, guys. My name's Luke, just listening in. Thank you for today's seminar, which I found very, very interesting. I work in financial planning, and I've got a couple of clients who've gone down asking about this, so it's been highly beneficial to listen in.
Right.
One question I did have, so when we've had people talking about building property kind of companies and how many properties and so on, one question we did get asked, which we weren't too sure on, was can you put your main residential property into the company and basically then pay a rent into it? So it's a kind of inheritance tax strategy.
Yeah, you can. You can do that. But like you say, it's going to cost you a rent.
Yeah. So if they have a large amount of wealth that they're trying to reduce, putting it into a company removes it from the estate almost immediately, from my understanding. And that could be another benefit to structuring if they've got a few rental properties plus their main residence plus quite a bit of wealth they're trying to reduce for inheritance tax planning. The company structure could be an additional benefit. I mean, would you agree, or is there something I'm overlooking?
It's an interesting one. I think, Luke, generally speaking, the home will be the last asset you dealt with from an inheritance tax point of view.
Yeah,
probably, because of what you just said. Because you've got to put there's 2 downsides to it, I suppose. One downside is you've got to pile a load of money into the company to pay the rent, and you don't get any tax. You got to pay tax in the company on receiving that rent. No tax relief for you personally.
Yeah.
First downside. Second downside is that you don't get your principal private residence relief exemption that people do for their house.
Yeah.
So you lose the ability to sell it tax free. So they're probably the reasons why that wouldn't normally be the case. It wouldn't normally be a practical solution. Now, there could be circumstances where you think, well, actually, but yeah, it might work. But I think you'd have to sort of look at the overall planning in the round and decide whether it was the last thing to do or not.
Okay.
I think the idea what you're suggesting would work from IHT, but it tends to be one of the last thing to think about.
Yeah, it's the question's really kind of testing the limitations, should I say? So I was just curious.
Yeah.
So thank you very much for that.
That's great.
Say about the main residence no rate band as well, because we've got that for IHT purposes.
Yeah, good point.
For the main residence. So
you lose that over 2 million though.
Yeah, that's right. Yeah.
Okay. Anybody else got any questions? If you have, just unmute yourself and we can ask the question. Anybody else want to talk? Should we just
Could I ask one question and then done? Yeah, all it is, I haven't looked into it before, but when you talk about rebrokering like a mortgage from a personally held property to it now being incorporated, are the interest rates, can you get a better interest rate because of the, let's say the value that the actual company is got in it, or, is there a benefit to doing that as well from the interest rates you can potentially get?
It's a good question. I think there tends to be fees. It tends to be more fees with a limited company. I think, especially if you're going to refinance, there tends to be fees. Most people that we've done it when we've incorporated, most people we've incorporated, they might have had 7 or 8 different lenders for the personal portfolio, and when they've incorporated, they've used one lender. So that's obviously given them a bigger lending with one particular financer, which I think, generally speaking, has proven to be okay. We've just got one where we did one 2 years ago, got a good deal, but the good deal's now coming to an end, so we've got to pay a higher rate of interest now. I don't think it definitely gives you an advantage on the interest. Okay. Some financiers don't really want to touch a new company, but they would tend to be lower complex financiers who don't understand the market. We do know brokers that we've used sort of help the clients with this, and you can put them in touch with those if you'd like, Luke.
No, that's great. Thank you very much, guys. I appreciate that.
So we've just got another 5 minutes. We could talk about a couple of case studies we've had recently.
I've got a question, if that's okay.
Yeah. Okay, John.
Not so much about limited companies, but it's more about the virtues of a declaration of trust for husband and wife when they are tenants in common, and just when you are changing the agreed proportion of ownership of the property with a declaration of trust. Can you do that more or less every year? And how does HMRC view that? Do they view that suspiciously or not?
One for your own?
Well, I suppose there's nothing stopping us from doing it, but it's gonna. I don't know how HMRC would view it, but from our perspective, it seems like quite sort of using a sledgehammer to crack a nut, really. If you're going to change that beneficial interest every year and redo the deed of trust to change that beneficial interest, it seems like a lot of work. Where just if there's just, are there going to be significant changes in the respective incomes of the spouses to warrant that kind of planning each year?
Okay, I'll rephrase it. Not every year, but let's say that it's 80% in the name of the wife in one particular year because she's not working, and then she goes back to work and the husband decides to not work for a few years, so his income is lower, and changing the declaration of trust at that point, there's nothing untoward about that. I
think what we tend to advise clients is, try and get it right if you can. So nothing's ever going to be perfect. It's like if you've got husband and wife owning the shares in a company. You know, you might obviously you can transfer shares to us and forwards every year if you wanted to.
Yeah.
But we wouldn't advise that. What we would say is try and get it as if you think one's going to be earning, 60, one's going to be earning 20, then try and get that balance on that basis. If things move and it's not perfect, that's just part of the game. But I think you're right. If you knew that actually there was going to be a change and there was going to be a significant change for like somebody, one person's going to be off looking after the family for a while.
Yep.
Then I think that's bona fide to change it, and that would be fine. I don't think we'd change it every year, but if you had, I don't see any reason why you wouldn't change it at that point. Then 5 years go by and then you change it again when that person comes back to work.
Yeah.
I think it's all a question of being sensible, really, and not trying to be too clever. I think is the general advice we'd give in that situation. It's never going to be perfect. Just sort of do your best, really. I think.
Sure.
Thanks, John.
Thank you.
What case studies have we got recently, Jack? Ryan?
Jack.
I'm calling you Jack. That's my son's name.
Yeah, we've got. I suppose we've got one that we're doing currently, which is for a property portfolio worth, I think, between about 2 and 3 million. In that case, it's quite the individuals involved. It's owned by a lady. She's unmarried, but her and her partner, who have been together for a long time, are quite active in the business. I think there's probably about 10 or 11 properties or so. Some of those properties having both commercial and residential aspects. And some of those properties being houses in multiple occupancy. So there's a relatively high turnover rate in terms of tenants. So our analysis of the situation, both in terms of the time involved that they spend working in the business and the activities that they undertake, has found that there is a business for the purposes of incorporation relief. However, because that property portfolio is only owned by one person, well, then there's no partnership and there's no possibility of a partnership, and so there's nothing we can do about the stamp duty land tax. We have, of course, looked at the stamp duty land tax and the reliefs that will apply, but stamp duty land tax, we're not going to be able to get relief in full. It's just a case of looking at the reliefs that are available for this transaction.
Yeah, good case study that. I had one whereby the incorporated was husband and wife owned ish, and they wanted to incorporate like an old mill that had been converted into sort of industrial units, so like a small unit for business people. And he bought it. I think they bought it about 6 years ago. So it's not got up in value that much, but it has got up in value. And obviously they paid stamp duty when they bought it. And we talked to them about incorporating for shares, but there's an issue around the partnership. I think things are the way that the wife had become involved in it didn't really, it was a bit flaky. The way that the paperwork they had in terms of how her involvement was in terms of ownership of the property wasn't as good as what he would like. And so the client decided actually he wasn't confident with the partnership. So we didn't incorporate for shares, but he decided it was worth paying the stamp duty and the SDLT to get this loan of, I think it's about 1.5 million quid loan. So he paid, I can't remember how much SDLT he paid. It wasn't a massive amount of money. Paid SDLT, CGT to give him that 1.5 million pound of loan. He kept about £300,000 of that loan for himself and for his wife. So he could draw that money out of the company as it made profits. And the rest of the loan he gave to his kids. So he split that, the balance of the loan, he split it into three. He gave a third each to his children. That loan can be gifted tax free. and free from IHT if they survive 7 years. So in that case, he decided it was worth paying the SDLT and the CGT to get this loan. And interestingly enough, after we did that, we then looked at the shares in the company and said, right, what can we do with the shares? Can we give some shares to the children, such that we're now passing value and equity down to the children in a sort of a family investment company type of manner. So yeah, every case is different. In that case, those two decide to push ahead. One of them paid SDLT, one of them paid both SDLT and CGT. So it just goes to show that each case is totally different. Okay, well, thanks for your time. That has been useful, and yeah, we'll